Welcome to In the Green, the podcast based on the intersection between life, finance, and the pursuit of breaking par. I am your host, Ryan Briggs with GFG Wealth Advisors. Time to tee off. Welcome back to In the Green podcast. We are joined again today by Mark Green, president of GFG Wealth Advisors. Today we're going to talk a little bit about retirement accounts. This is a hot topic and a vast majority of what we do for people and how we help out. But we want to dig into some of the common things you hear. We just want to lay out kind of the basics of what this means, what that means. You hear all sorts of stuff on the news and it can be confusing, between the news, social media, mailing advertisements you get trying to sell you financial products. It can all be very confusing. So we're going to hopefully lay some things out and help make it more digestible. So, Mark, let me ask you a question. I want to save for retirement. I've got, let's call it 30 years till I want to retire. Why in the world wouldn't I just stash everything away in my savings account?
Yeah, great question, and we get that a lot. And to your earlier comments, opening the segment here, what we try to do is lower that intimidation barrier. And
sure.
So,
it's a real thing.
And you're exactly right. There's a lot of noise out there about, should I do an annuity? Should I do a 401k? Should I do a Roth? Should I do an IRA? Should I do a SEP? Should I do, what do I do? And that's where we come into play. And so that's a great question. Why wouldn't you just stock some money away? Why not? What kind of a retirement account do I need?
Yeah, unless the bank folds, I've got all my money right there. Right?
Exactly. And, do I put it in an IRA CD? Do I put it in a IRA mutual fund? What do I do? And so we try to lower that barrier, and that's kind of our mission at GFG Wealth Advisors. But what do we do if a client comes in, got 30 years till retirement? The number one thing we're going to look at, and it's almost counterintuitive because you and I may not be able to actually do it for them, but we want to look at your 401k. Where do you work? What do you do? Because that is an immediate impact on your savings, and most companies will match up to 3, 4, 5% of the first 3, 4, 5% you put in. Mm-hmm. And so the first thing that we do, we talk about 401k plans. And if the company matches, are you doing that? Because if you're not, you're giving up free money.
Absolutely. So for everybody listening, as we're investing in the market, we're trying to get a good rate of return. But there's not another place out there where you can get 100% rate of return.
That's correct.
Which is when your company offers you some kind of match, they're going to match you dollar for dollar. And that's why that's very important to understand. That is 100% return right off the bat.
That's right. Okay, so then once we establish, can you or should you be using a 401k plan, we look at your income, both your individual income, if you're married, your joint income together. Do you file separately? Do you file jointly? And then we look at the income tax brackets, and are you eligible for certain types of retirement accounts? Mm-hmm. And that's something that we can help you with, because at certain income levels, you start phasing out of being able to contribute to a retirement account, whether it be an IRA, which is a tax deferred, it reduces your taxes now, but you pay taxes later when you take it out at retirement, or a Roth, where you don't pay taxes now, and at the end of the day, you pay the taxes now, but at the end of the day, when you retire, you don't pay taxes on that money.
Sure.
So what you put in or the growth, so it's all tax-free stuff. But that's, a 10,000-foot view. Those are the things that we look at. If you're self-employed, do we do a simplified employee pension plan?
Right. Because if you're self-employed, you're likely not going to you're not going to have anybody offering you a 401k with a match, right? But that doesn't mean that there's not things you can use your business for to help you.
That's right, because there are solo 401ks.
Sure.
And it's all of those things that are pretty intimidating that we try to knock those barriers down, explain it in layman's terms, offer you the best product and service that it's right for you.
Certainly. And, I remember being a young professional and I see all of this out there. I hear about a SEP IRA, I hear about a 401k, I hear about an IRA. I didn't know what it meant, and I thought it was so unbelievably complicated. And I'm thinking, man, how am I ever going to, how do people do this? Well, after I hired a professional and I was taught of what all of this means, it's really not that complicated. Once you have it broken down and what's going on, if you have somebody really walking alongside you, it's really understandable material. And a lot of it's just written in IRS tax code, so that's why it can be a little confusing.
Yeah, absolutely. And, I'm kind of overusing the word intimidating, but that's what I've heard over 35 years is, I don't understand it, I don't want to understand it, it's intimidating to me. But, the other part of that is that it's pretty intimidating as a young person. Let's say, in your case, let's say you're talking to a 30-year-old golf professional, okay? Maybe the golf professional knows that his time is maybe 10 years, 15 years. That's all he's really got to really pour money into some kind of retirement product.
Sure.
But he's timed this money up for 30 years or 35 years until retirement. That's pretty intimidating. Yes, you can get to your money. There's penalties for getting to it. And so that's kind of intimidating. So we try to break that down and, as you mentioned, walk step by step over his career, over his lifetime to help him lower those barriers and make him understand that this is why we're doing it, and we're walking with you as you do that. And we'll make other recommendations for your other monies, but your retirement money is your real money for later in life, and it's very important you start early.
Absolutely. Yeah, it's just utmost importance to understand everything, and just to have it, to be educated. I went through a great school system here in the state of Texas. I have a business degree, and I can tell you, neither of those institutions really touched on how to personally retire. I even went through finance classes, but that really taught me how to calculate finance, not necessarily the personal behaviors involved with making sure that you're able to, stash money away effectively, how to budget, things like that. And that's something that we do successfully every day.
Yeah, and we don't take for granted. We all know in our business that the three most important things and emotional things for people are their relationships, their money, and their health.
Right.
And so we don't take any of those lightly, and we try to really lower the barrier. Again, and the intimidation thing, I just keep coming back to it.
It's important.
It's so prevalent, and we just try to lower that to take that stress off of your financial life.
Yeah, you've seen it in people. Once you have everything under control and in a game plan, the peace you can find in your life is incredible.
Yep.
Versus being scared by the elephant in the room. You're friends with the elephant now.
Yeah.
It just makes life a lot more peaceful to live.
Well, and in my 35 years, Ryan,
I should say makes life more peaceful to live.
Yeah, absolutely. And I will tell you, in my 35 years, I can't tell you how many times, it's more than the 10 digits on my hands, that people have called in their mid to late 50s. Here's my statement. How am I going to retire in 10 years? And the statement says they have $10,000 or $50,000 or $75,000. It's
going to be hard.
It's going to be very hard.
Yeah.
It's going to be extremely hard. And so I tell them, you've only got a couple of options, and it's save more money, work longer, or invest more aggressively. Those are the only options you have.
Yeah.
And 9 times out of 10, they're I'm not going to have enough money. I'm going to have to keep working.
Keep working.
And it's unfortunate because if we'd have had that conversation when they were 35, they'd be in a much better situation or a much different situation than they are in their mid to late 50s.
Yeah, in your equation there, the one thing you can't do is roll back the clock, right?
Correct.
Yeah, time is your friend.
Correct.
So, let's move on to a different topic here. So when we're talking about retirement accounts specifically, it's important to understand what pre-tax means and what post-tax means. It's all about how your income is treated within the year. When do you pay taxes? Can you break down? Let's start with pre-tax here. What does pre-tax mean, and what types of accounts fall into the pre-tax category?
Perfect. Pre-tax means that if you make, just use a round number. Let's say you make $50,000. You put money away. Pre-tax, that's going to reduce your taxable income. Instead of your taxable income being $50,000, whatever you put away is going to reduce your taxable income by that amount
within that year. So if you make 100, you put 50. Round numbers here. You make 100, you put 50 away. Your taxable income's 50.
That's correct.
Okay.
That's correct. And going back to what we said earlier, that is exactly why the first conversation we have with a client when they walk in the door is, where do you work? How much money do you make? And do you participate in your 401k and do they match? Because that is pre-tax dollars. So what that means is you set up a 401k and let's just hypothetically say your employer matches 3% of your first 3%. So you want to put 3% in your 401k plan. So if you make $50,000 a year, you take 3% of that income, you're putting it into your 401k. Your taxable income is $48,500 because that's $1,500 of taxable income that you have made tax-free or tax deferred. So you move it over to the 401k, and by the way, by the end of the year, your employer is going to match $1,500 as well because they're matching 3 of your first 3.
Now, we all know there's 2 things in life that are non-negotiable, and that's death and taxes, right?
Correct.
So on pre-tax investments, when do you pay the tax?
when you take the money out at retirement. And you can start taking the money out at 59.5 without a penalty. Anything before that is the double whammy, as I like to say. You pay 10% early withdrawal tax. Okay, so let's say you take out $1,000. You have to pay $100 in early withdrawal penalties. And when you file your taxes, you have to pay taxes on the whole $1,000.
Right.
Even though you paid $100 in taxes or in penalties, you still have to pay taxes on that full $1,000. Municipal bonds.
Sure. The big one that we hear about is Roth IRA. So a Roth
Correct.
IRA is an incredible tool for somebody to use. It has a ton of benefits. And because of that, your limit of what you can put in per year is cut off at, I would say, a decently low point. In the year of 2023, it's $6,500. If you're over a certain age, it's $7,500. But effectively, a Roth IRA, you're able to put post-tax dollars in. So you're going to pay the tax on it in 2023. You're going to put $6,500 in there every year until you retire, hopefully. And the beauty of that is on all of the growth that happens within that is tax-free because you've already paid the taxes on the front end, as well as when you take it out after the age of 59 and a half, that is also going to be tax-free dollars. And correct me if I'm wrong, but when you there's no required minimum distribution for that as well.
That's correct.
Yeah.
That's correct.
Huge benefit. You can let it grow and you can pass that along as well.
And it passes on to your heirs tax-free.
Perfect. And then other types of post-tax accounts would be, let's talk about it, if you came to us with $10,000, says, hey, I want to put this in the market. I want to get this going in some ETFs. Talk about how the taxes on those kinds of accounts work.
Yeah, absolutely. The exchange-traded funds, mutual funds, stocks, even bonds. Bonds, they pay interest, just like a CD. Any income that you earn on that is income that would be added to your taxable income. Dividends, interest, all of that is income. But when you sell an investment, if you buy it at 10 and it goes to 20, you get $20 for that one share of that investment, but you paid 10. The difference, that $10 is called a capital gain. Mm-hmm. And right now you pay 15% on long-term capital gains, or 20%. I'm sorry, 15% on capital gains if you've held them more than a year. Short-term capital gains, you pay at whatever your tax rate is.
Sure. Perfect. So thank you for helping me cover pre-tax and post-tax. That's a massive part of understanding how the whole retirement world works. It really is kind of the breakover point for a lot of different things.
Yeah.
So when we talk about IRAs, we talk about 401ks, we talk about Roth IRAs. So we're going back and forth between pre and post tax here. What types of investments can I put into these accounts?
The 401k is going to be limited. And that's why when you come in and you sit down with us, your financial advisor or your prospective financial advisor, we talk about what's in your 401k, how are you investing, what are you doing? Because there's going to be a limited number of mutual funds or exchange-traded funds that you can invest in that, and we're going to help you with that. Okay? We're going to give you, kind of a 10,000-foot view. We can't tell you how to invest it, but we can tell you what you have.
Sure.
Okay?
At the end of the day, it's your decision to make.
Correct.
Right.
That is correct. Okay, and so then we look at if you have left your company and you want to roll that over, you're thinking about what do I do? We show you other investments because we have the opportunity to invest in just about anything in the marketplace, whether it's mutual funds, ETFs, stocks, CDs, bonds, whatever it may be. And so what's available to you in your 401k is limited, but what's available to you outside of that in a rollover IRA, in a Roth IRA, in a SEP or simplified employee pension plan that you may have with us, or a solo 401k that you may have with us. We can do exchange traded funds, we can do mutual funds, we can do individual stocks. But I will tell you, in our practice, we like to guide you more towards exchange traded funds because they're more efficient, they trade like stocks. You're diversified in one investment, not that you will have one investment, but it's easier to diversify you over the whole marketplace.
Sure.
Through exchange-traded funds, more efficient than mutual funds, and they're cheaper.
Okay, fantastic. In talking about, if you leave a company, speaking to my generation here versus, your generation.
Thanks a lot for that.
Exactly. Hey, you've got a lot of wisdom up there. But your generation tend to stay at one place for a lot longer.
They do.
Than my generation has.
The transfer portal generation.
Exactly. Yeah, it's not just collegiate athletics that are immune to this.
That's right.
It's very common nowadays, for you to work somewhere for 2 to 3 years, collect some retirement there, go to work somewhere else for 2 to 3 years, and maybe on your third, fourth stop you find some place you want to stay for a while. One of the things that we really help people do is go back and collect all of those old retirement accounts, and we can get them into one fund. Because once you leave a place and your money's just sitting there, you can't add to it. You can change the mix of what it's in. They'll allow you to do that. But it's really just stuck in whatever investments they provided for you. And generally speaking, you can find some benefits from collecting everything together and all having it work in one direction.
Yeah.
So that's a big part of what we do. So, Mark, that's really all I have for you on this episode. Appreciate you stopping by again. Make sure to like, subscribe, and download this podcast wherever you get your podcasts. We hope to see you in the 19th hole. Thanks for listening to our episode today. Make sure to like, share, and download our episodes wherever you get your podcasts, and we'd really appreciate a review. Hope to see you in the 19th hole. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized finance advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of GFG Wealth Advisors. It does not necessarily represent those of RFG Advisory, Private Client Services, or their clients or their employees. This commentary should not be regarded as a description of advisory services provided by GFG Wealth Advisors or RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA, SIPC. Advisory services are offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, GFG Wealth Advisors, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.